Good evening, friends. In this daily economic brief for India, I will cover key macro indicators, policy changes, and market developments, drawing on the FY 25-26 outcomes and the FY 26-27 outlook. We will discuss India's GDP growth, monetary policy stance, fiscal health, market trends, and relevant global context. The aim is to provide a concise, professional analysis tailored for finance professionals, highlighting the main drivers and implications without straying into speculation. Let's begin with an overview of India's current macroeconomic backdrop. India at a glance, FY26. India enters FY27 from a position of strength. The economic growth registered 7.7% in FY26, with quarter 4 of FY26 accelerating to 7.8% year-on-year, the strongest quarter of the year. This robust growth has been accompanied by a contained inflation. Current CPI inflation is around 3.5%, comfortably below the RBI's 4% target. Given this benign inflation, the RBI held its policy repo rate at 5.25% in the June 2026 review, indicating confidence that the inflation trajectory is manageable and prioritizing continued support for growth. Finance markets are steady. The BSE Sensex today closed at 73,919 of 0.5%, reflecting resilient investor sentiment. The rupee is stable around 95.5 rupees per dollar, and India's foreign exchange reserves stood at $682 billion, equal to roughly 11 months of import cover, which provides substantial buffer against volatility. In summary, strong growth, low inflation, and stable market characterize India's macroeconomic environment as we step into the new fiscal year. India's GDP growth, FY26 versus FY27 forecast. Last year's GDP performance was impressive. India's GDP grew by 7.7% in FY26, propelled by robust domestic demand. In fact, Q4 FY26 came in at 7.8% year on year, marking the strongest quarter of the year. This indicates the momentum was high going into the fiscal year's end, with the household consumption and investment being key drivers. Looking ahead, we expect growth to moderate but accelerate. The FY27 GDP growth forecast is at 6.6%. This slight slowdown is not a sign of weakness but rather a normalization from a high base, along with some anticipated global headwinds. In other words, after a stellar 7.7% growth in FY26, a 6% expansion would still be healthy and in line with India's medium-term growth trajectory. It suggests continued expansion, albeit at a more sustainable pace, assuming no major new shocks. The moderation is driven largely by statistical base effects and a softer external environment. So, the growth story remains fundamentally positive. Monetary policy, RBI's calibrated pause. The is in a pause mode on interest rates. In the June 26 policy meeting, RBI kept the repo rate unchanged at 5.25%. This decision signals the central bank's comfort with the current inflation trajectory and a desire to support ongoing growth. Inflation is about 3.5% now, which is below the 4% medium term target, giving policymakers leeway to hold rates steady. However, inflation is expected to rise going forward. The RBI projects FY27 CPI to average at around 5.1%, possibly peaking around 5.9% in the third quarter of FY27. This limits the room for any rate cuts in the near future, as the central bank must remain vigilant that inflation does not overshoot. The RBI's stance thus balances present stability with caution about the future. They highlighted key watch points for inflation such as food and energy prices, monsoon performance, and global commodity trends, factors that could influence whether inflation stays benign or rises faster. Additionally, in a structural move, the RBI expanded the fully accessible route FAR for foreign investors by opening 15, 30 and 40-year government bonds to foreign investment. This long tenor market access aims to deepen the bond market and encourage stable foreign capital flows without the need to adjust interest rates. In sum, the RBI's message is steady as she goes on rates, with a close eye on inflation risks and innovative measures to support the financial markets. Inflation dynamics. Inflation currently subdued at around 3.5% as of June 26, but pressure are expected to build later in the year. RBI forecasts CPI to rise to 5.1% in FY27 with a potential peak near 5.9% in quarter 3 of FY27. This means the current calm may not persist. Why the uptrend? Partly due to seasonal factors and base effects. For example, food prices often increase during certain seasons depending on monsoon outcomes, and these could push inflation higher. Also, the very low inflation readings now create a base for higher year-on-year figures later. Key watch points include the monsoon performance, which affects crop output and food inflation, as well as crude oil prices and other global commodities. If rains are weak or global oil prices jump, inflation could exceed the forecast. The inflation trajectory is central for future RBI decisions. If inflation indeed climbs towards 5 to 6%, the RBI would likely maintain a cautious stance and hold off any rate cuts to avoid fueling price pressures. In short, inflation is low now but is expected to pick up in the coming days. So, this will be closely monitored as a crucial factor in policy and economic planning going forward. Fiscal policy and government finance. The government is charting a path for fiscal consolidation. For FY27, the fiscal deficit target is around 5% of the GDP, down from recent years. This demonstrates a commitment to gradually reduce the deficit, balancing the need for growth, promoting expenditure with debt sustainability concerns. By signaling a medium-term consolidation plan, policymakers show that they are prioritizing keeping public debt under control rather than resorting to larger new stimulus spending. Market indicators reflect this fiscal stance. A 10-year G-Sec yield is around 7.1 to 7.2%, which incorporates a moderate risk premium for inflation and fiscal borrowing. These yields suggest that investors are reasonably confident about the government's fiscal discipline and the inflation outlook. They are not demanding much higher yields, which is a sign of credibility. At the same time, the government is looking to boost growth through structural measures rather than excessive spending. For example, Commerce Minister Piyush Goyal is actively facilitating global investments in the pharma sector, which could potentially double the industry to $120 billion in size. Such initiatives aim to drive economic growth and job creation without burdening the budget by attracting private and foreign capital. Additionally, India's external position remains strong with forex reserves around 682 billion covering 11 months of imports. The country has a solid buffer against the external shocks, a fact that also supports confidence in the rupee and overall macro stability. In summary, the fiscal picture is one of controlled consolidation. The government is holding the line on deficits, supporting growth through reforms and investment promotion, and maintaining robust external buffers to mitigate the risk. Capital markets and currency. Capital market of India and currency are stable, reflecting the solid fundamentals. The BSE Sensex equity index closed at 73,919, which is up 0.5% for the day, indicating that investor sentiment is resilient. Stock prices have held near record levels, suggesting that domestic investors remain optimistic about corporate earnings and economic prospects. Meanwhile, the rupee is trading at around 95.5 rupees per dollar, a level that has been relatively steady. The currency's stability, despite some global pressure on emerging markets, is buttressed by India's ample foreign exchange reserves of $682 billion, providing confidence and cushion against potential capital outflows. Government bond yields 10-year around 7.1 to 7.2% are steady, pricing in the fiscal and inflation outlook without signaling distress. Notably, the RBI's initiative of opening long-term government bonds, that is 15, 30 and 40-year maturities to foreign investors via the fully accessible route FAR is now in place. This is expected to attract more foreign inflows into India's debt market and deepen market liquidity, which should further reinforce stability in bond yields and the currency. Overall, market conditions are calm and reflect confidence in India's economy. Though it is understood that large external events could still pose risk, the bottom line, equities and the rupee are stable, supported by strong fundamentals and policy measures aimed at maintaining investor confidence. Global context, headwinds and tailwinds. India's macro outlook is shaped by global environment, which is a mixed picture. Global growth in FY 2026 is projected around 2.5%, relatively subdued. This slower world economy means external demand for India's exports may be soft and global trade growth is modest. Major central banks have divergent paths. US Federal Reserve is expected to hold interest rates steady through 2026, keeping global financing conditions relatively stable. No new tightening shock. However, this also means US rates stay at a high level, which can limit the capital flows to emerging markets like India because investors continue to find attractive yields in the US. Meanwhile, the European Central Bank is still hiking rates to combat inflation in Europe, which is which can further slow European demand and generally tighten the global liquidity. Geopolitical risks are also part of the backdrop. In West Asia, Middle East, Iran-Israel tensions have also been an overhang. Although a recent conditional ceasefire eased oil prices by 1%. Lower oil prices are a direct positive for India's import bill and help restrain inflation and the current account deficit. Since India imports the majority of its crude, but the situation remains fluid and any re-escalation in that region could push oil prices. In summary, globally we see headwinds, slower growth, tightening in some regions and a few tailwinds, stable US policy, slightly lower oil price for now. India's policymakers and market participants are mindful that our strong domestic fundamentals exist within this global context which requires vigilance. Key risks and watch points. Finally, let us consider the risk and factors to monitor for India's outlook. On the upside, domestic demand remains a strong pillar. Consumer spending is resilient, which can keep growth momentum going if confidence stays high. Additionally, investment initiatives are a potential upside. For example, the push in pharmaceuticals and manufacturing with government facilitation could significantly boost output. The pharma sector could perhaps double to $120 billion. $120 billion. If global investments materialize. Also, foreign capital flows could improve thanks to measures like FAR expansion for long-term bonds, potentially increasing foreign participation in our markets and supporting financing for the growth. These factors could lead to growth outcomes even stronger than baseline if they pan out strongly. On the downside, inflation is a key concern. If CPI inflation does rise towards 5.9% by Q3 FY27 as projected, the RBI will have limited scope to ease the interest rates, meaning borrowing costs could stay higher and monetary support for growth is constrained. Fiscal space is also limited with 5% of fiscal GDP fiscal deficit. The government has less room for stimulus if the economy needs a boost. A big additional spending push could undermine the fiscal targets or unsettle markets. External risks include the rupee's vulnerability at 95.5 per USD currently. It is stable, but a shift in the global risk sentiment that is more hawkish Fed could cause capital outflows and put pressure on the rupee. Thankfully, India's large forex reserve of 11 months coverage acts as a buffer to support the currency in such a case. But a sustained outflow could still be challenging. Another critical risk is oil prices. Any re-escalation of conflict in West Asia could spike crude oil prices, worsening India's trade deficit and adding to inflationary pressure. Lastly, a structural factor to watch is the 2026 monsoon. The monsoon's performance will significantly influence agricultural output and food inflation, which in turn affects the rural income. And the overall inflation peak is projected for later part of the FY27. In conclusion, while India's baseline outlook is positive, these risks must be monitored. The trajectory for growth and stability will depend on how these upside opportunities are harnessed and how effectively the nation mitigates or responds to the downside risks, especially on inflation and external fronts. Now, coming to the end, I thank you for your kind attention to the matter. This concludes the daily economic brief. In short, in summary, we can tell that India's macro fundamentals are strong, but prudent vigilance is necessary regarding the inflation path and global uncertainties. Thank you.